Good afternoon, everyone. We'll just wait for a few more seconds for everyone to come in this informative, interactive webinar that we have um, ready for you. My name is Jesus Padilla. I am the Assistant Director here at the Florida SBDC at FIU, along with my colleague and business consultant, Jose Monte, that he is our Access to Capital Consultant. Some general housekeeping items. This is a recorded webinar, so in case if you have to step out, answer a phone call, don't worry. All participants will be receiving today's presentation and also the recording through our YouTube channel. So definitely encourage you to like and subscribe. If you have any questions throughout today's presentation, I strongly encourage you to put them in the Q&A so that throughout today's presentation, either myself or Jose will be more than happy to answer those questions for you. Hi, Lori. Thank you for coming for today's webinar. Okay. So I'll go ahead and proceed. So this is a good opportunity for you to introduce yourself. What type of business do you have? What type of industry? Along with what is your pursuit for capital? Are you looking more for traditional commercial loans, SBA-backed loans, grants, investors? But like that, we have a good idea based on who is in today's presentation, but also provide you some key resources for you to become successful in obtaining capital, along with the connections and resource partners that we have in the community. So before we proceed, allow me to introduce you once again to Jose Monte. He will briefly introduce himself from his expertise and his knowledge on how he's able to assist small businesses to obtain financing to address the business needs. Jose?
Good afternoon. Thank you for everyone for joining us. Just a little background on myself. I've been an ex-banker here in South Florida for 30 plus years, running areas such as commercial real estate, corporate lending, commercial lending, and business banking. So I'm here to hopefully, Jesus and I can give you some information and guidance and to make your process of finding capital easier.
Thank you, Jose. Okay, and I just have a question here. No, correct. There is no certifications or attendance providing for attending this training. Okay, perfect. And then in regards of absolutely, yes, Jose can assist if your business is located here in Miami-Dade County. He will be more happy to assist you with any restructuring of any loans, or also having a financial forensic analysis of your finances to create that strategic. If your hands are being raised, strongly encourage you to put them in the Q&A or in the chat, so like that throughout today's presentation, either myself or Jose will be more happy to answer those questions for you. Yes, correct. All participants are here present will be receiving today's presentation and also the recording for our YouTube channel. So who we are, what we do, we have a team of specialized business consultants at no cost. If you're looking for access to capital, marketing, international trade, growth, and operation strategy, we have specialized business consultants to assist you. Here's a photo of some of our team members when we received the National SBDC of the Year in 2023. We are a resource partner of the SBA that provides the one-on-one consulting, training, and information to small businesses that are physically located here in Miami-Dade, Monroe County. If your business is located outside of Miami-Dade County, don't hesitate, shoot me an email. I'll put my email in the chat. So like that, I'll be more than happy to connect you with your local SBDC to assist with your business needs. Great. Yeah, the microphone is muted for everyone, so you'll be hearing me. Since the center started in 2014, I'm sorry, we have provided consulting to Miami-Dade businesses and the Florida Keys. As such, over close to 8,000 small businesses we have worked with that have resulted close to 119,000 hours of consulting. With the assistance from our business consultants in the realm of access to capital, we have helped small businesses to obtain close to $462 million in capital. What is BizCap? It is the business Growth and Acceleration Program is an initiative that the Florida SBDC at FIU has run since 2016. It provides the hyperlocal consulting, training, and outreach to small businesses in targeted communities and commercial corridors. It provides an additional tool in the toolkit for communities looking to better assist their businesses with startup assistance and business growth. Some of the outcomes after the partnerships with the multiple communities here in Miami-Dade County, we've gone door to door. What is the heartbeat of small businesses? What are some pain points along with the resources for them to be successful? And with the consulting and training, over 300 small businesses participated in those efforts. So in total, close to 700 businesses have been part of the BizCap project. Here's some previous photos of our past projects. In the top left-hand corner, we worked with the Downtown Development Authority in the Flagler corridor, along with the City of North Miami Beach, that we have done different programs and initiatives in some targeted commercial corridors in the city, as providing additional trainings, workshops to enhance the ecosystem of the small business needs in City of North Miami Beach. The BizCap project in Florida Congressional District 27 is funded by a grant by the U.S. Small Business Administration. The Florida's 27th Congressional District covers the city of Miami, Key Biscayne, Coral Gables, and runs through Kendall down to Color Bay. From the 2019 census, over 86,000 small businesses are established in District 27. So what are the three core activities that we would like to focus on? Is the training, the outreach, the door-to-door canvassing, the one-on-one business consulting, the data mapping and surveys of small businesses located in Florida Congressional District 27, but to work with you, the small business owners, as our goal is to work with and assist 1,000 small businesses in this calendar year. That includes assistance through the consulting and trainings and workshops as such you're here present today. So we're going to go over the 4 course objectives in financing your business. And think of it as the 4 key walls of your house. It is the questions to help you determine your business financing needs, identify the various financing options for your business. Once again, no two businesses are the same, no two industries are the same. Perhaps that, my financing options will vary from Jose's financing options. Along with the available financing options and the pros and cons of each of those options as well. Okay, and then I just received a question. Yes, if your business is located in Broward County, just shoot me an email. I'll be more happy to connect you with your local SBDC at the Florida SBDC at FAU. So as a sample for Penny for your thoughts, despite having the idea or being good at entrepreneurship, it is often difficult to start up a business. We all know that. Equity is a key element for a startup small business venture, but you must explore the different financing options in order to provide added equity for your business for surviving. Jose, when you're working with small businesses and they ask you, Jose, I need funds, and one of the key questions you ask them, how much, and they tell you as much as I can. What are some additional assessment questions that you provide or guide them to have an attainable number for financing?
Yeah, I mean, obviously, one of the key things before you have that meeting with your lender, whichever lending source you decide is the best one, is to do an analysis of what amount of capital you need. You can't the question of, or the statement of, as much as I can get. That's not what a lender works with, and that's not what a lender wants to hear. He wants to know that you've gone through your numbers, your business, and you come up with an amount that's reasonable. And number 2, can be supported by what your financial activity and results are. I mean, if you're making no money, you can't walk in and say, looking for $500,000 to grow my business. I mean, it doesn't make sense. So you need to have your financials in order, business bank statements, and be able to explain the amount of capital that you're seeking, how that capital is going to translate into more sales, and at the end of the day, more profits. That's sort of just kind of, in a nutshell, which you have to know when it comes to loan amount. You can't just walk in and how much can you get? You need to have an amount that makes sense, that is supported by your current financial results.
Thank you, Jose. So this is where, as a segue, based on what Jose was saying, before you investigate the financing options for your business, the first thing you need to do is to assess your current financial situation. You should not only know how much capital you need to get started or expand your business, but also know how your revenue streams will look in order to pay back any debt financing. Okay, Jose, I have a question for you. Is your financing options only for businesses already operating or newly formed business ventures?
Well, if let's make a definition. Yeah, startup means not a business that started last week. Startups mean businesses that typically are less than a year. But if you register your business and it's in some biz and you've gone, but you haven't yet developed your product or your store or your service provider, whatever, if you have zero sales, you have no activity, you're in the toughest sector to find capital because you're unproven. So from a lending standpoint, almost there's lenders out there that are non-traditional, non-banks that will consider lending to you, but they want to know what are your revenues. You could have started 3 months ago, and that's a startup, but they want to know that your business is generating sales. So if you've got no sales and no profits, you're in the hardest sector to find capital. These businesses tend to have to bootstrap themselves, and there's partners, there's venture capital, there's investors out there. There's different platforms that Jesus, I'm sure we'll get to. But from a lending standpoint, if you've got no activity today, you started your business last week, and you're going to start finding capital is extremely, extremely challenging.
These are some key questions to ask yourself. What is the nature of your need? How urgent is your need? How great are your risks? In what state of development is your business? And for what purpose would the capital be used for? What is the state of the industry? Is it growing? Is it decreasing? Is your business seasonal or cyclical? How strong is your management team? How does your need for financing mesh with your business plan? Okay. And then if you're starting off from ground zero, Jose, it is based on bootstrapping, start marketing organically to get the funds and then
correct.
generating sales.
And there's other ideas that we can discuss, one-on-one. It depends. And you may have to look at some more personal resources rather than the business to get the business jump started. Again, we're talking about lenders. I mean, lenders, even non-regulated lenders like fintechs or community-based, they're in the business of lending money, collecting it, lending it out to another small business. So there's got to be some support for repayment. So if you don't have it, obviously there's other areas. You have to bootstrap, credit cards, consumer type lending products, investors, friends and family. I mean, those are the areas you're going to have to focus on if you've got zero sales, zero activity.
Then in the chat, obviously, we're focusing more on businesses are physically located here in Miami-Dade County. But my recommendation, if you're located outside of the state of Florida, shoot me an email, which I'll put my email in the chat. So I'll be more happy to connect you with your local SBDC in regards of any potential grants or financing options in your state. You could definitely touch base with the county. They might have some municipal grants, beautification grants, the community redevelopment agencies, or the business improvement district in your area. They might have something, but at the end of the day, no two businesses, no two industries, no two cities, no two states are the same. So you shoot me an email and we'll be more happy to connect you with your local access to capital consultant in your closest SBDC. Okay. And then by estimating the startup cost is to determine how much capital you need to start with, and you must estimate the cost of doing business for the first few months. Some of the expenses will be one-time based, such as the fee of incorporating your business or the price of a sign for your building. Some will be recurring costs like the utilities, inventories, and the insurances. Jose, for you, what can affect the interest rate when requesting a new loan?
Okay, I mean, interest rate is obviously dictated by the market. Today we are in a higher than normal interest rate market. What affects the interest rate is risk. Risk is the number one factor that affects interest rate. If you're coming in to get an unsecured small business loan, as opposed to a commercial loan with real estate, the real estate loan will have a much lower interest rate because there's tangible collateral. Business loans tend to be a little higher because the reliance and the focus is based on financials, the management team in place, and the ability for the historical sales and profits to continue into the future. So the rates are a little higher. It also depends if you're a client of the bank and you have a deposit relationship. There's other factors that are taken into interest rate, but typically the biggest one is risk.
And then, this one I could answer it, but at the same time, Jose, you could chime in as well. For nonprofits, what assistance do you give to nonprofits needing funds to purchase equipment and warehouse expansions? Will banks lend to nonprofits? The Florida SBC does not work with nonprofits, but we'll be more happy to connect you with some of our nonprofit organizations that we work with, to assist you in that regard. Then, Jose, from your experience, how is the lending process for nonprofits?
Yeah, I can tell you, don't get stuck on the word nonprofit. Businesses that are nonprofits, you're talking, could be a hospital, could be a church, and there are lending institutions, banks that do lend to them. It just, in those particular cases, it depends. Since a nonprofit that started last year, this is a nonprofit that's been around for 10 years, so longevity in a nonprofit, but banks do not shy away from nonprofits just merely because of the nonprofits. Nonprofit is a taxing term. It's not they nonprofits obviously have to generate revenue sales. At the end of the day, the sources have to be utilized for the nonprofit for the tax benefits. But no, there's lenders out there for nonprofits. Just depends. Depends, what kind of nonprofit you're talking about.
Okay. And then, over here, okay. Yes, and then I have another participant that they have a solid business plan, keep getting turned down by banks is a very tough process indeed. Yeah, and shoot us an email, and we'll be more happy to connect you with Jose, also with the resource partners in the realm of access capital, and perhaps a microloan might be best suited for you to get the ball rolling. So there's different options. So it's a good opportunity to connect with Jose, with our Florida SBC consultants, to address all the different financing options for your business. Okay. Then the essential expenses can be divided into two separate categories: the fixed and the variable cost. The fixed expenses includes the rent, the utilities, the administrative costs, the insurance costs, while the variable expenses include the inventory, shipping, packaging, the sales commissions, and any other costs are being associated with a direct sale of the product or the service. With the debt and equity financing, there's two different options. The debt financing is borrowing money that must be repaid over a period of time with interest, while equity financing, it's raising capital in exchange for a share of ownership in the business. So that's when you have to pick which route is best for you. You're welcome. There we go, Jose. The microloan might be a route. Yes, and shoot me an email, as we have great colleagues that will be able to connect you and assist you with the microloan route as well. Yes, and then what is the rate of those loans? It varies. So my recommendation is, I've already received your email, and I'll be more happy to connect you, give you a list of our colleagues. So it's best for you to do the due diligence and see which one is best for you. Because once again, no two businesses, no two industries, no two banks, they have the different appetite or risk appetite based on the industry that you might have. And then, Jose, do you help with consolidations of loans?
Sure. If you're talking about refinancing, consolidating loans and refinancing with a new loan, sure. It's going to depend on repayment capacity. And if those loans are in trouble, that's a different story. If those loans are just higher interest rate loans, and obviously you're on time with the payments, and and that's working out. Just looking to maybe get the rate down because you got them at a high interest rate or from a particular lender that's a high interest rate lender. Yeah, we can take a look at that.
Then with debt financing is borrowed money that must be repaid. Repayment is done over a period of time with interest. Lender doesn't gain an ownership interest in the business, and the loan is often secured by company's assets or borrower's personal guarantee. Then Jose, I had a question in the chat in regards of the collateral side. Can I use my personal collateral to secure a business loan? They have an Amex blueprint business line previous through Cabbage. It's good usage, payment that existing can the payment of existing line to request additional loan from another lender.
Sorry, what's the exact question again?
Yeah, can I use my personal collateral to secure a business loan? That's
Sure.
the first question.
Sure. Yeah. Lenders have no problem with taking collateral, especially real estate. No problem at all. Now, putting personal collateral up for a business loan is just there's pros and cons to that. So you got to be careful. You got to be careful with that. If you're talking a personal, you got a second property condo on the beach or condo somewhere else, and you want to pledge it. That's one thing. Pledging your personal residence, there's pros and there's cons to that. You need to be very aware of the risk of the business loan going bad and secured by your personal residence. So there's risk.
So the second one, they have an additional business line since 2022. Could they demonstrate the good usage and payment of the existing line to request an additional from another lender?
You're talking about taking out that loan and transferring it to another lender.
Requesting another lender, like requesting an additional line.
An additional line
from another lender.
Lenders, when it comes to lines of credit, a new lender is always very reluctant to give you an increase on an additional line of credit because the 101 question is if you're banking with Ocean Bank and you have a line of credit with them, why don't you ask Ocean Bank for the increase? That's your first spot because they know you've been handling the line of credit. So getting an additional line for the same activity with a secondary lender is not necessarily your best option. And that lender's going to say, well, I'm assuming Ocean Bank has a UCC one. They're going to have a preferred interest on your inventory, receivables. So what am I going to get? So that's the most lenders do not like to do that. Now they'll pay them off if you're a good business with good financials. They don't have any, and Ocean Bank for whatever reason doesn't want to lend anymore. And a new lender may not have a problem in totally taking out Ocean Bank and giving you a bigger line and paying them off. And then they're your one lender. But giving you an additional line of credit to another bank is a difficult ask.
Some of the sources for the debt financing could be the banks, savings and loans, credit unions, the SBA guarantee loans, state and local government programs, along with the family, friends, and former associates. The equity financing is raising money in exchange for a share of ownership in business. One of the most common forms of equity funding comes from venture capitalists, which is a private equity investor that provides capital to companies exhibiting high growth potential in exchange for an equity stake. It could also be friends, relatives, employees, customers, but most importantly, the industry colleagues, as they know the ins and outs, the good, bad, and the ugly, in regards of that industry. This is where Jose was talking about the having good credit, and it's one of the 5 C's. Your credit history is the first picture that you will give your prospective creditors on why you should be considered for credit. When a small business requests a loan, one of the first things the lender will look at is your personal and your business credit history. So before you even get the start of the process of preparing for a loan request, you want to make sure that you have a good credit history. We also have organizations that can assist you for credit repair, financial wellness, so like that you'll be credit ready when the time is right. The collateral is the additional form of security in which can be used to assure a lender that you have the second source of loan repayment. It could be assets like the equipment, the buildings, account receivables, inventory are considered possible sources, but it can also consist assets that are usable in the business as well as personal assets that remain outside the business. So it's best to touch base with Jose, with our consultants, to see which is the best conservative and alternative route to use your collateral. Jose, sometimes folks put in their house as collateral. What are some of the risks having the house as a collateral while you're seeking funds?
Well, you're talking, it's your personal residence. It's the roof over your home. It's where you live with your family. So if the business, if the business runs into trouble, just give an example. Look what happened during the COVID era. Look what happened 9/11. I mean, unforeseen things in the world happen that affect businesses. Imagine you're owning a restaurant during the COVID, a small restaurant. Some you could struggle and make it through, and some many have closed and many have survived, just depending on how financial solid or strong, or other factors where you're located, etc. But so you put your residence at risk on a business loan. Now, if it's a short term need, let's say you got an equity line in the home, and I'm giving you sort of general topics, but I can get to you specifically. There are some pluses if you've got a well-established business and you're looking for a short-term capital for a short-term period of time, could be a year or two, or what have you, or you're looking to expand, and a home equity line, which is typically a second mortgage on your home, it's fairly attractive product. You can write off the interest. It's a fairly a low interest rate, easy process. Depends on the equity, and that can help you out. But the idea is that that's sort of a small finance that you need there for, could be for some beneficial, to buy some products at a low rate because you get certain discounts of the year. For short term capital, it could be something. But for survival of your business, putting your personal residence is risky. Is risky because if the business suffers, your biggest asset, which is your home, is at risk of being foreclosed. You can lose it. Simple as that.
And then, can you please do a quick summary of the business credit score? What is an ideal business credit score for potential borrower?
Yeah, there's no ideal business credit score. I mean, obviously, the longer you've been in business, the more and obviously, if you haven't borrowed, you're not going to have much of a business credit score. So it all depends. So if you're new to borrowing, the business credit score is going to be really immaterial to you. Lenders will focus on the credit score or the credit history of the owner or management of the business, whoever owns it. If it's a husband and wife, if it's two partners, they'll focus on their credit score as a reflection of how the business is handled. If you've got great credit score, they view it as the business probably run in a very, very, very well responsible manner. If you've got poor credit history, poor credit score, they view it as if they can't handle their personal credit score in a responsible way, chances are the business credit handling will also be handled in that same very loose fashion. Again, but this is quick and dirty, and we can talk more one-on-one. But banks like the highest and the best credit scores. Non-traditional lenders, fintechs, community-based lenders, CDFIs that we deal with, you can have a credit score of 580, and that's okay with them. They focus on other factors because they're there to help small businesses, but that's something we can get into one-on-one on your particular case. But there's many different lenders that require many different credit scores to consider a loan application.
Then this is where to start doing a full analysis of what type of financing you're seeking. Is it more a short-term or long-term financing? It's in the form of an overdraft, letter of credit, while the long-term financing, it is more on a form of a leasing of bigger entities like a building, a warehouse, or heavy-duty machineries. So the term of short-term financing is generally less than 1 year. It provides quick ways to get liquidity. However, short-term financing has higher interest rates and in general doesn't fulfill the long-term capital investment needs that you're seeking. While the long-term, it's financing for more than a year, the repayment is generally in the mode of payback. Equipment that is costly can be taken a long-term lease, which a business can eventually buy it out. And it is provides stability, but the total interest paid over a long time is higher. So there's always pros and cons, just like if it's okay, perfect. So it's like it's like buying like a second mortgage, in other words, but this is more like the heavy machineries that you're able to repay back because you're investing it back into the business, to repay back the loan, but at the same time to grow the business as well for business expansions. Then the types of debts or loans available to you and the terms of those loans would typically determine your business organization, whether you're a limited liability company or organization of some other kind. So the 7A loan is one of the most common loan programs. It provides financial help for small businesses with special requirements. It could be used for real estate as part of a business purchase, but also the short-term, long-term working capital, refinancing a current business debt, along with the purchase of furniture, fixtures, and other supplies. Some of the basic usage, it is the construction of a new building, renovations of an existing building, revolving the funds based on the value of an existing inventory or receivables, refinancing the existing business debt under certain conditions. Jose, what are some other options or usage that folks can use a 7A loan for?
Yeah, 7A loan is a business loan in essence. There's usually not collateral tied to it, but it depends. Sometimes the SBA, they'll approve you for the loan, and depending on their comfort level, they may say, okay, I want a second mortgage on your home. I want a second mortgage on your commercial building, on your commercial condo warehouse, on whatever it is. So it depends. But this is more of your business financing, as opposed to the 504, which is long term, which is what we consider long term fixed rate financing. The 7As, the rates, just so you know, they're adjusted every quarter. The 7A loan today, in my opinion, is not very attractive. It's a very high interest rate loan. Talking interest rates probably from 11 to 13% today. So it's a very high interest rate today, and that's adjusted every quarter. If rates go down, then obviously your interest will go down. But interest rates have yet to go down dramatically in the last year or two. So we will see.
Then I have a question right here, or a comment that one of the participants' bank is willing to lend us the money. However, the interest rate is 7%. So based on what you're saying, that's fairly.
I would not walk. I would run. I would run and I would sign. 7% today is I'm assuming it's 7% fixed. I'm not sure what your loan. If I'd be happy to take a look at what they're offering to you and give you my opinion. But I can tell you, if they're offering you 7% today for any extended period of time, I would not walk. I would run and sign. Because 7% today is an extremely aggressive rate. You're only seeing that on a long-term fixed rate, with commercial property.
And then the 504 loans, it provides a long-term fixed rate financing for a major fixed asset that promotes the business growth and job creation. It includes new facilities, long-term machineries, equipment, and existing buildings or land. Then we talked about the microloans originally, but the SBA microloan program is another viable source of loans for your business. The microloan programs provides loans up to $50,000 to help small businesses to certain nonprofit childcare centers start up and expand. Microloans are available through certain nonprofits, community-based organizations that are experienced in lending and business management assistance. So individual requirements will vary. So definitely shoot me an email. I'll be more than happy to connect you with our colleagues that provide microloans here in Miami-Dade County. And then, Jose, from your experience working with some of the microlenders, do some ask for the sales, the financial statements of like at least 6 months? Some require some business plans, some don't. What is like the common denominator between all the microlenders? Like one of the similar asks.
Yeah, I mean, obviously, the first thing that they're all going to want to see is they're going to want to see your bank statements for the last 90 days. In other words, they want to see your business bank statements, business, not personal, business bank statements for the last 90 days. And obviously, I'd like to see last year's tax return, 2023. If you're on extension, depending on the amount of capital we're talking about and on the community-based lender, some of them will not focus on your tax returns. But to answer the question on sales, everybody focuses on sales and profits, because that's what pays the loan back. So even though some micro lenders will not, if you don't have the tax returns, they can bypass that, but they want to see your most recent 90 days of bank statements to see what the money coming into the account is, because that's sales. Whatever you sell, you have to run it through your bank statement. And obviously not just running it through, but obviously they'll see the debts coming out, the expenses coming out of your business bank statement. And at the end of the month, hopefully you've got a decent positive balance. If the money comes in and it goes out at the end of the month, you've got an overdraft, a negative balance, doesn't help, because that means obviously you've got more expenses than you've got sales revenues coming into the account. So it doesn't help you. But they'll look at that as opposed to tax returns, depending on smaller amounts, like a micro loan. We can go with business bank statements, and hopefully you've got your 2023 tax return. That can help as well.
With the venture capital, is a form of equity financing that addresses the funding needs of the entrepreneurial ventures, which for reasons of size, assets, and stage of development cannot seek the traditional source, such as the public markets and banks. So the venture capital investments are generally made as cash in exchange for shares and play an active role in the company that they're being investing. So pretty much it becomes like business partners. Here are some pros and cons of venture capital. The good thing about it is that venture capital, which you can raise, is the money that you can keep. You don't need to repay or take account of the interest rates. You don't need to attach collateral for raising capital. It can help your business grow quickly, and it's a generally committed and long-term financing. The venture capitalists will own a stake of your business and might at times, depending upon the amount invested, make those controlling decisions. So raising capital amounts to giving up a share of your business. Jose, with you, what's a good conservative approach of seeking venture capital? I know that no two businesses are the same, no two industries are the same. So what's a good formula based on the business valuation in the raising venture capital?
Well, I mean, in all honesty, for the bulk of the small businesses that we're probably dealing with, venture capital may not be an option for you. Venture capital, if you think of it sort of as Shark Tank, to give you an idea, we all know what Shark Tank on TV is. And they typically obviously like businesses. You've got to have a business you come up with a better service, a better product. You've got to have something that is going to attract the venture capital investor. Obviously, we have some sort of technology. You come up with some technology, some new app, something that's that has potential. But you've got to have, for venture capital, you've got to have an idea, a product, a service that has big potential. If you're just opening up another, say another dry clean or another restaurant, venture capital is really not what's going to be for you. That's what you call friends and family. You take on an investor, obviously that will give you X amount of capital for a percentage or a return or what have you. Everything is negotiated. But venture capital, again, you've got to have something unique, a service, product, something you come up with. Because venture capital, he's willing to give you the money, but he's looking for the high returns down the road. And that's why he takes a piece of the business. He's only going to do that if he sees that there's growth, there's good growth potential.
Okay, perfect. Yes, and then if you're interested to get in contact with Jose Monte, I'm going to put my email address in the chat so that I'll be able to make that connection and assess Jose's availability to schedule a meeting with you. Okay. With the angel investors, the business angels are high net worth individual investors who seek high returns through private investments in the startup companies. They typically invest in ventures involved in industries or technologies with which they are personally familiarized with. One of the advantages is that angel investors may provide you the needed capital right at the startup stage of your business. They generally agree to the flexible investment agreement terms compared to those traditional sources, but they may agree to invest in your business even if it's a risky venture, if they like your idea, and are often ready to look beyond a mere financial return. On the other hand, the angel investors generally are not ready to make the follow-up investments. They can be costly at times and want high returns on their investment. An angel investor may often want to be involved in those decision-making process of your business and you may virtually lose control. It can be difficult task to find angel investors that are usually operate behind the scenes. So make sure that set the terms from the get-go, but at the same time, if being partners with angel investors, you have to have those conversations in those strategic decision making for the success and the growth of the business. With the crowdfunding is one of the common ways for bootstrapping for startup businesses tend to get capital. It's another form of accessing funds. Platforms such as Kickstarter, Fundable, and others can help build the brand awareness and also test the market for your business idea among investors and consumers. This is a good opportunity for you to do a sample market research. There are 4 ways to do crowdfunding. One is donation-based. Donors give money for nothing in return. Equity-based investors provide funds in return of the shares of the business. Debt-based is investors are repaid with interest, and rewards-based is those who donate receive the products or service in return. So there are different avenues how to crowdfund your business venture, but see which is the best route for you to address that need. Peer-to-peer, it's essentially involving sharing your idea with other people in hopes that they will invest in your business. You will determine how much you need to borrow, define the purpose of the loan, and post your listings online. In this way, you find the takers, and you might have a source of financing of your business. So, for example, if who would like to invest in my business venture, and if anyone that's interested, based on the terms and the amount I'm seeking, it will be a good opportunity to have the peer-to-peer venture route. But it gives you the advantage of choosing a host of lenders and settling for repayment terms that is best suited for you. It makes it possible to avoid the lengthy process of taking a loan for the conventional source. But the disadvantage of financing is that the terms of the lending can often be vague, and the lender may have certain hidden terms of the lending. So you should check carefully, once again, do the due diligence before you go ahead with this model of financing. Jose, I know that with you, some of your clients, they have received funds from family and friends as one of the options. So this is where some of the clients have lacked the strong credit history or don't want to hassle dealing with the lenders. So turn to their friends and families. So what are some areas in regards working with friends and families while they're getting funds from them?
I mean, some of the
yeah, like pretty much like what are some of the processes, or like do they become partners, or they become investors, lenders? Yeah. So what's the I know it's a touchy subject.
Right. Anyway, when you're dealing with friends and family, everything is negotiable. Now friends and family is a good source, but you got to be careful because sometimes things don't go the way that you project them to go, and then happens. You may have issues with friends and family. So there's downsides to depending, if you're getting it with no strings attached, if you're getting with certain expectations, but everything is negotiable. All these platforms, all these options, everything is negotiable. You can simply, you can simply negotiate. The lender may say no, this is the deal, you take it or leave it. Friends and family, obviously, it's a great one. That to me is a great bootstrapping type of funding source to get your business going. Because obviously, in most of the cases, they're not looking for much. They're investing in you, and depending on your idea and your product or what have you. So that's a good source to approach, but you got to negotiate everything and have it. I would put everything in crystal clear in black and white to avoid. If it's money for nothing, then it's money for nothing. Put it in black and white. If they expect, hey, this business takes off down the road, then, you pay me 10%, then you put it all in black and white. So there's no confusion. There's no issues. The business does not go forward. The business makes money, as to what your obligations are, with the family and friends.
Yeah, because after all, it's a business transaction. But and then how about like the term rates? That's everything negotiable, right?
That's negotiable. I mean, typically family and friends. I mean, I've seen where, you've got it at 10%, and 10% is high. Well, but 10% when you cannot get $1 from any lending source due to X reasons, 10% is cheap. And if 10% gets your business going and gets your business up and running, and generating sales, that's a cost of doing business. You're not going to have that for the rest of your life. But if paying 10% for a year or two is what it takes to get your business launched, up and running, and in the market, at the end of the day, it could be cheap. You've got to analyze that whether it makes sense for you or not.
Thank you. And then for as a small recap, determining your financing needs will be the first step in looking for those financial options for your business. It's determining your financing needs, those various options for your business. Explain the available options that are out there, but at the same time, list the pros and cons of each of those financial options. So here's the next steps. Here is where I want to give you the homework before Jose, the lender, they give it to you. It's analyze your financial situation of your business. Determine the financial needs of your business, arrive the exact amount of financing that you need, and the purpose for which you need it for. Step 2, create a business plan. So you could put in the chat if you have developed a business plan, thinking of doing one. I want to know your experience of the business plan, because like that, I'll be more happy to email you the link of our upcoming presentation that we have on how to create a business plan. So this carries a conversation of the purpose of developing a business plan, which is getting the eyes of a potential partner, lender, investor, where you're approaching for them for potential financing. Evaluate the financing options that is best for your venture. Once again, the pros and cons of each of those options, and decide on the option that suits your business best. And last but not least, or one of them, it's approach the lenders and the investors after you have decided the financing option that best suits for your business. Approach them, negotiate with them to secure the investment. If you've decided on a loan, review on how your business venture is bankable with the terms, and focus on the 5 C's of credit. The 5 C's of credit is the character, the capacity, the capital, collateral, and the conditions. And Jose, how important are the 5 C's as a former banker and you having a conversation with your clients of the 5 C's? How important is this?
Yeah, more so today, I think, than ever, especially because we're in a digital age. I can tell you almost any lender, any traditional lender, we're talking about banks now, and these are the ones that focus really on the 5 C's of credit. Character-wise, they'll put your name in a Google search and they'll add a million prefixes to make sure that you've got a clean record. You've got nothing out there, no lawsuits, anything. So character is important. Obviously, the capacity to pay. There's got to be some capital. You need to have some liquidity. Collateral, small business loans typically are not associated with tangible collateral. Their collateral is usually viewed in the form of UCC1, which is obviously accounts receivable, inventory, any prepaid deposits. That sort of could be equipment, depending on your business, and then obviously the conditions that are surrounding both conditions of any financing, conditions in the marketplace, and condition of the business. So there's many different factors. And again, a business plan, I think, is good, even if you're looking for an increase, because if you're going to a new lender, a business plan gives a lender sort of a summary of what the business, where it came from, how it's performing, and where it's going. So it It gives the lender knowledge about the business, not just you're coming in for a loan amount and what have you. The longer you've been in business, probably the less relevant a business plan could be. But it depends on the amount of capital you're looking for and other factors on how important a business plan can be, especially with a lender.
And once you've secured the financing, you can concentrate on using this best to expand your business. And then if there's any particular questions, because I think that I have answered almost all the questions in the chat, strongly encourage you to put them in the chat or in the Q&A so that I'll be able to answer those questions for you. Once again, this is a recorded webinar. All participants will be receiving today's presentation and the recording as well. So definitely encourage you to follow us on our social media channels, but definitely like and subscribe our YouTube channel, which is at BizGap. So we have a plethora of upcoming recorded webinars that we have to enhance the conversation with the business consultants. But at the same time, visit our website at bizgap.miami as we have a plethora of upcoming events to enhance and tailor for your business needs once again. So let me see if I have any additional questions for you, Jose. And we'll take it from there. Okay, perfect. Yep, I have answered all the questions right here. So once again, I want to thank everyone for attending today's webinar. If there's any way that we can do to assist you, don't hesitate. Shoot us a call, shoot us an email, and I will be more than happy to assist you with any way we can. Perfect. Thank you. And I'll see you soon. Have a good Monday, and we'll be talking soon. Take care, everyone.
Good afternoon, everybody.